That's right. Bitcoin is all about mean reversions. Now, what does that mean exactly? No pun intended. Well, if you've been watching my channel, you know I trade the VEPs, which is the volatility, entropy, probability, and statistics. And I like to trade Bitcoin, among other things. Now, if you look at any asset, and particularly volatile assets, but any asset really that's traded on the market, you'll notice that they do two things, really. And there's a number of things where they do two things, but essentially, in the main interest of people who are trading or investing, assets do two things. They move away from the mean of returns, and then, at some point, they mean revert to the mean of returns. Right? They revert to the mean of returns. They don't revert to the mean of price, necessarily or at all. Because price is not the thing that mean reverts. Right? Price just follows the returns. Price is set by the volatility, and the volatility is the standard deviation of returns. So, you cannot use the former price to predict the future price, just like you cannot expect an asset's price to mean revert to a particular mean of price, because that's not how it works. This is partly because, first of all, you can't use a word to define itself, and you cannot use a metric to calculate its future self in the same way that you can't use, for example, the price of anything you're buying or selling, whether you're trading it on the market or in a private sale, right? The purchase or sale price of a particular object, item, goods, or service will not determine the price of the next one. If anything, the price will just follow the returns on what that object was bought and sold for. That's literally all it is. So again, assets move away from the mean of returns, and then once they moved enough from the mean of returns, they mean revert. Right? They revert to the mean of returns. Now, why am I saying this? I'm saying this because if you look at Bitcoin over the past weeks and months, on daily time frames, weekly time frames, 7-day time frames, monthly time frames, you'll notice that the price of Bitcoin has followed the returns very nicely and has mean reverted many times, as it does on many different time frames. And it remains in mean reversion on many time frames right now. And some, in higher time frames like 7-day, are in mean reversion to RMLRs, which are reverse mean of log returns, which are down quite far away still, in the low 40,000s area. Last I looked, it was around 44K. And that number is rising a little bit. And by mid-June, could possibly be around 60K, we'll see, late June. The power mean, 30 power mean on the smooth link 10 is also rising. So if it does complete a mean reversion to the 3012, as the probabilities indicate that it will, because that's what assets do, well, we could be looking for some nice shorts between now and the time it mean reverts. Does that mean it's impossible that it will go higher from now? Well, actually, no. Right? So if you're looking for short-term scalps, low time frame scalps, right? Low time frame volatility trades, there's plenty of mean reversions to the upside, just as there are plenty to the downside. Now, if you work your time flow, your time frame, or if you work your workflow, I should say, and you look from the high time frames down to the low time frames, you'll notice that there's mean reversion with a propensity to the downside now on the higher time frames, as I've been saying for months that there would be, and I've been saying for almost a month and a half now that there was an ongoing mean reversion on the 7-day time frame, right? It's been in mean reversion really since, like, before the all-time high. So, and yes, that just demonstrates mean reversions can happen in a continuation to the upside if it's going up, or in a continuation to the downside if it's going down, or in a reversal if it's going up, or a reversal if it's going down, or sideways. It can happen in any direction. But the general propensity at the moment for that 7-day mean reversion, for that mean reversion on the 7-day time frame, at the moment is looking very much down. Does that mean it has to complete the mean reversion this week? Well, obviously not. It hasn't completed it for the last 6 weeks or so. But at some point it will. And when I say it will, I mean it will complete that mean reversion with an extremely high probability of doing so, as in more than 99%. Right? It will complete that mean reversion to that 3012 RMLR on the 7-day time frame before it hits the third band up of the RMLR, of that same 3012 RMLR, right? That's, again, the third band up. So the third standard deviation band of the RMLR to the upside. Now, why is that important? Well, it's important because it means you can use that third band up as a gauge to an area it is almost certainly not going to hit before it touches the RMLR that's currently the downside. Why is that important? Well, because it means that any longs you take from where we are now up to that area where the third standard deviation band to the upside is, you can limit your move so that actually where's the last place you could possibly get out before it touches it, with the probabilities being on your side. So why is that important? Well, because it means that if you do that correctly, you're far less likely to miss your move when you want to take profit if it does have some kind of a crazy run up to the upside and comes very close but doesn't quite touch that third standard deviation band to the upside. It also means that you know what the probabilities are along the way that it is likely to have in its effort to get to that particular third standard deviation band. So you don't have to be greedy, and you can take profits on trades on a lower time frame and not get stuck in a move that gives you crazy profits if it's going up, and then reverses on you because you were sure it's going to keep going up, but the probability said no, it's not. Right? So you don't have to ignore the maths. You can use them to your advantage. Now, why is that useful? Well, it's also useful because when you know what your guide is, your sort of border is to the upside, you also know what your target is on the downside, right? And it keeps moving, of course, as the candles pass by, right? The future RMLR keeps changing, right? That's the point. the RMLR is able to tell you the future RMLR with incredibly high accuracy because of how it's built. And as each candle passes, the data is updated, so the end of that future line, whatever length you have it set on, or lengths, right, updates. And generally speaking, the candles that are set in place, the lines that are set in place already for more than a candle, they typically don't move, right? Once it's painted, that's it. And it's very rare, but it does happen, but it is very rare that you get a change of direction on an RMLR of a current candle if there's a crazy outlier that happens that is significantly negatively correlated, for example, with the returns driving the price action a certain way on that particular active candle. Why is that useful? Well, because you can see very clearly whether or not the asset and its returns are correlated positively or negatively, and that tells you whether or not the direction is likely to be up or down, especially when you have the direction predictor, which is a separate indicator that is baked in to the RMLR. Now, why is that useful? Again, if you know the likely direction of the asset based on the returns, and you have a highly accurate direction predictor, which we do, and you see the distribution levels based on the distribution models that we use, the normal distribution and the Laplace distribution. If you know where those distribution levels are by using something like our VRE chart, then you are not going to be surprised by the areas that the asset hits from move to move. Just look at the last week of candles, like on the 15-minute, for example, on the VRE chart, and with the normal distribution levels and Laplace distribution levels on it. And tell me that that is somehow just luck. There's no way. We know that those are the levels that the algorithms are looking at. Why? Because they're using the same math that we use, which are the most highly relevant maths related to actually making trades. The mean, the return, standard deviation of returns, right? Entropy, whether or not an asset is in a trending move or a random walk, right? What the correlations are on volatility and on entropy. The returns oscillator, and whether or not there's div or divergence on them. The entropy oscillator, and whether or not there's divergence on that. The alpha laser returns, which is a returns oscillator, effectively. Just an older version of it that we have that shows you different reads and presents it to you in a different way, in a simpler way, really, than the returns oscillator. Both of them extremely accurate. Both of them can be used for different kinds of trades. Personally, I like to use the ALR more on super low time frames. I also like the returns oscillator on low time frames, and all time frames really. But I do like, making entries on the divergences of the ALR, because it's quite good at finding very fast divergences that last maybe 1 or 2 or 3 candles on like the 1 minute time frame. For example, does that mean you cannot use the returns oscillator for quick moves like that? Well, absolutely you can. There are plenty of divergences on the returns oscillator that are very quick, and that you can scalp 1, 2, or 3 minute scalps, get in, get out quickly, using the divergences of the returns oscillator, especially if you use relatively low length reads, like a 7 or whatever. Now, what does that mean for you as a trader of Bitcoin? Right? And how does this all fit in with the upcoming big event we all know is happening on or around 420? Right? Ha, very funny meme time. But seriously, just a few hundred blocks from now, even less, right? About a day and 10 hours from now, or a day and 8 hours, whatever it is, there's going to be a halving, right? And as a result, we all know the block reward is going to get cut by the usual and always programmatically built in 50%. So you're going to see people who mine continue mining for even half of the amount of Bitcoin that they were earning in the last 4-year cycle. Why does that matter to you as a trader? Honestly, it doesn't. Why does it matter to you as an investor? Well, quite simply, when the asset is producing 50% less new supply than it did previously, and the market demand remains the same or higher, because typically market demand will grow over time, especially on a relatively new asset. Remember, it's only about 15 years old. Well, demand goes up, supply goes down, price go up. That's macroeconomics 101. You don't have to be a genius to figure that out. Which is why, if you're not a trader, you're just an investor, DCAing into an asset like Bitcoin is, generally speaking, has proven to be so far, the smartest way to acquire Satoshis or Bitcoins and just hold them for a ridiculously healthy return over time. And typically speaking, even if you invest at the top, which is not where you should invest, but if you do, typically within 4 years or 5 years, you see a crazy return, right? So it could be 20%, it could be 40%, it could be 80%, it could be more, it could be 100% or more, it could be hundreds of percent or more. Depends where you bought. But generally speaking, people who invest and hold for a period of several years are generally quite happy with their returns. Personally, as a trader, there are far more gains to be had on low time frame trades if you know what you're doing, right? If you don't know what you're doing, of course you can lose it all very quickly, and most people do, and you probably don't know what you're doing, because if you did, you wouldn't be looking up on YouTube how to trade mean reversions, or what is mean reversion, or how to trade volatility, or how to trade Bitcoin, or all those things. In fact, you're probably not looking up how to trade mean reversions or how to trade volatility, because if you take traditional technical analysis seriously, well, then you're just buying into a whole bunch of hullabaloo, which is really just absolute garbage information, because it's built on lagging indicators, and that's not going to help you trade low time frame volatility. Partly because they don't even have volatility indicators, like real volatility indicators in traditional technical analysis. They don't even discuss returns or means, let alone mean reversions, right? It's all about triangles and channels and EMAs and SMAs that are all lagging in price, or just chart art based on silly nonsense like Fibonacci's. They're wonderful in nature. You find them in a bunch of places. What does it have to do with trading? Absolutely nothing. Completely subjective. Anybody can make anything with any fib they want. It's absolutely balderdash. So with actually relevant maths, you get real levels that are calculated properly by high quality math, and as a result, you have a better understanding of probabilities and statistics, right, for those particular elements of the trading. So think about this. If technical analysis, traditional technical analysis worked, right, then why wouldn't there be more than 1% of retail traders consistently profitable? And if trading the VEPs didn't work, then why would most people who use it laugh at how nonsensical traditional technical analysis is and never touch it with a 10-foot pole once they learn the VEPs? Because they realize, yeah, no, voodoo TA is literally, technical analysis is voodoo TA. It's absolutely silly nonsense, and the VEPs make sense and always plays out. Even when there's randomness that throws things off by, outmaneuvering a probability. Happens a bunch. But it's all calculable, and it's all visibly seen very accurately on the VEPS indicators, and it can all be very well traded. And keep in mind, most assets are in a random walk most of the time. What does that mean? Well, that means you're actually trading assets in a walk most of the time, unless you happen to only trade when moves are trending. And you know when that is. Again, our entropy indicator shows you exactly when an asset is in a trending move or in a random walk on any given time frame. And yes, they could be in random moves and trending moves at the same time, just on different time frames. That is entirely normal and happens all. Right now, if you look through the different time frames on Bitcoin, you'll absolutely find, a trending move on one time frame and a random walk on others, right? And in fact, you could find possibly a trending move on more than one time frame and random walks on others. It's not at all unusual. It's completely normal. So, what does this mean? All in all, for Bitcoin traders, it means, first of all, you should learn how to trade the VEPs, because it's a proven model, which is why it is used by actually professional traders on the market. There's no question about that it works that way, and that's why professional options traders and other professional traders at HFT firms and the like have been using volatility, probability statistics, and increasingly entropy to trade high-frequency trades. Right, using bots that are trading more than 1 million trades a second at extremely low time frames, like less than 0.2 seconds per trade on average. And they do that by having big bags, and they just have to move, the asset one small little tick up or down and take their profits. Maybe if they're feeling daring, they'll go for 2 or 3 little ticks, maybe 4, but not, as soon as the move is made, they take their profits, and they're already running the next trades. Again, they're running more than 1 million trades per second, so they run them all at once, constantly running trades. And they're small trades relatively to the size of their bags, right? That's how they do it. They run a bunch of small trades, and they win most of them. And they move the markets, quite literally, right? It is unusual for a properly run HFT firm to have a losing quarter. It is not at all unusual for people that use traditional analysis, even so-called smart hedge funds, to lose money, because they use traditional technical analysis or other nonsense lagging information like news that has nothing to do with actually trading. It may affect macroeconomic issues, maybe, but it really doesn't. What really does is the VEPs. All the news and everything else is just a load of hogwash, right? So keep that in mind. And yeah, happy trading.